All right, well, it looks like we have a good number of people here. Welcome. I'm really excited to talk with the panelists that we've invited to join us today about the topic of ESG and responsible venture capital. Before I introduce the panelists, I want to do a little bit of kind of housekeeping. So we encourage you to ask questions as we move along. And we will also be taking a poll quickly about, or shortly about, who are the people attending the webinar and sort of their knowledge of ESG and responsible investing, so that we can tailor the conversation to answer some of your questions. So what I'd like to do is start by kicking off and asking, sort of just getting a sense of who is in the audience. So Natalie, if you could share the poll. Ooh, lots of entrepreneurs and okay, it looks like we have a good mix of lots of investors, fantastic, and entrepreneurs, as well as executives. Thank you for joining us. We're excited to talk about ESG. And to help us kind of gauge where to go with the conversation, can you also let us know a little bit about where you are relative to your understanding of ESG? So Natalie, can you also share that? Okay, fantastic. Looks like we have some people with some experience and some that are new. So it's a good mix, and some experts as well. So that's fantastic. It looks like we're going to have a really interesting conversation. So to get us started, I think what I want to do is just give you a sense, introduce you to the panelists. So starting with the first thing I want to mention about the panelists is that they all kind of share something in common, which is that they've all contributed to the body of research and this year with respect to responsible investing and also ESG with respect to venture capital. So first, let's start by introducing Jasper. And Jasper is the Corporate Governance Officer at FMO. And FMO is a Dutch development bank with a very interesting mandate, and also someone who has been sort of a pioneer, I think, in the space of both impact investing and ESG, with a particular focus on emerging markets. So Jasper, would you please let us know a little bit more about what your day job is and tell us some more about FMO?
And it's work as a corporate governance officer in FMO. What I actually do on a daily basis, I work with our clients and investees on the topic of corporate governance. And that might be from a very risk-driven perspective. So sometimes if we want to invest or we want to do a debt transaction, we do our DD on corporate governance, and we have to make sure that it meets a certain standard, or that we actually can move the client or investee to a certain level. So that's kind of the risk management element of that. But also more importantly, even for a development bank, is that we support our clients and investees in becoming better in terms of corporate governance. And that means very much focusing on the value add approach, or with the idea to move companies further so that they over time can attract commercial funding, in certain cases that they're actually ready for an IPO or any kind of other liquidity event. So we try to address it from that perspective. And I'm part of the impact and ESG domain in FMO, and I focus the vast majority of my time on corporate governance. I have a number of direct colleagues that focus on the topic of ENS and or the topic of impact.
Fantastic. And you make, FMO makes both direct equity investments and also invest in funds.
Yeah,
Is
we
that
do
correct?
direct private equity investments. We do investments in funds, and we do also do debt transactions. We even have a number of portfolio guarantees, trade finance, grants, but the vast majority is direct equity, fund investments, and debt transactions.
Fantastic. And next is Hillary Wick. Hillary is the senior analyst at PitchBook. Hillary has also been on the investment side as a director of investments. And so Hillary, if you could take a moment to kind of share what you focus on at PitchBook and a little bit about your background, that would be helpful.
Yeah, so I joined PitchBook in January from a background of having been an institutional investor, which is a perspective that's not widely held at PitchBook. So it's actually been really great to be able to bring my perspective to this data provider, to the private markets. So I joined the editorial team where we put out a lot of research that's built upon our data. So it's providing analysis and insights off of our data beyond just here's a bunch of data, figure it out for yourself. So I've been writing a lot of educational pieces this year talking about how institutional and other investors access private markets. I just put out a paper on fund fees and terms and nuances behind them that people should understand better. And then I think it was my second day on the job, I was asked to take a look at and run the impact in ESG practice in the editorial group. So I've written a paper kind of defining sustainable investing for PitchBook, leveraging off of work that Morningstar, our parent company, has done, as well as our sister company, Sustainalytics. And then I also ran the survey and published a report on it on sustainable investing that drew from limited partners, general partners, and service providers to those groups that we published last week, and which 500 Startups was kind enough to support us.
Happy to do so. Thank you, Hillary. So Susan, you are you a fellow or a former fellow at Harvard Kennedy School's Belfer Center? First question. And secondly, I want to say, as I was looking through your bio, you have worked on so many projects that I just love. You know, the OECD, the BSR work that you've done. I find it just fascinating. And so could you share a little bit about your background and what you're working on currently?
Yep. So I was a fellow the last 2 academic years at Harvard Kennedy School. There's a new project called Technology and Public Purpose. And the goal was really to think about different ways to work with technologists, scientists, and governments and private sector to make sure that the next generation of technologies, the ones just coming out of the labs today, are developed in ways that protect the public good. Most of my focus was on artificial intelligence and frontier life sciences as part of that project. But they also work on things like cyber security and other topics, data privacy as well. My background prior to this, I was at Business for Social Responsibility, which is a network of corporate social responsibility teams and ESG teams at about 250, mostly multinational companies and large investors and asset managers. I led the team on inclusive economy. So I was working every day with companies on whatever challenges they had related to their workforce, product affordability and access, bottom of pyramid markets, community government relations. We were sort of responsible for that whole suite of issues, public health, topics like that. Before that, I spent the first sort of decade of my career doing emerging markets. I was overseas, mostly in Africa and the Middle East, facilitating foreign investment in the transport and energy sectors into those countries.
Fantastic. And I'll take a moment to introduce myself. So I am Tracy Barba, and I wear a few different hats at 500 Startups. I work on global marketing, and I'm also the director of ESG. And I spent the majority of my career started in tech in Silicon Valley, and then moved into venture capital, and mostly on the fundraising IR side, and then went over to impact investing about a decade ago. And now I'm back to early stage technology investing at 500 Startups and leading the ESG initiative. So for us, I want to just quickly go back for a moment and just share everybody the interview. So the introductions, obviously we've just done. We'll spend a little bit of time talking about definitions. the rise of ESG, some of the challenges, opportunities, and how to get started. And then just for fun, I thought it would be interesting to the extent that possible to do 2021 predictions these days. So at any rate, we'll start with terms, because I know this is a big topic. People use a lot of the terms interchangeably. What I have done is put together sort of a very kind of short, simple view of the world according to me, and how I see the differences between ESG impacts, sustainable investing, and responsible investing. And would love to just hear from the panelists, you know, how, if this matches with what you're thinking and in your own research, if there's anything that you would add to this, and I'll stop there.
Shall I go first?
Yes, please.
Yeah, from the perspective of FMO, and I think development banks in general, I do think that the kind of the sequence that's provided here, from traditional investing to ESG investing to impact investing, I think especially in the case of FMO, and I think it applies to more development finance institutions, is that I think first and foremost, an investment should have a certain impact. So it should either be focused on, let's say, reducing inequalities, providing renewable energy, affordable energy to some of the communities we try to serve in the markets we operate in. From our perspective, the ESG angle comes in from the fact that we operate in markets where we know that the ESG standards in most of the countries or individual companies are not up to a certain level. So it's kind of a given that we have to assess ESG as part of our investment DD and our investment thesis. And it's basically, in the case of FMO, the assessment of our environmental, social, and corporate governance is part of every single transaction. Obviously, it depends on the risk profile, on the kind of company, but it's part of every single investment. As said, both from a risk management perspective, so making sure that we address the potential risks that are there from an ESG perspective, as well as trying to see whether we can create any value there. And that value might be in relation to the investment as such, for example, in the financial value, but also in terms of how can we create value towards the broader societies that the companies operate in.
And so would you characterize yourself as an impact investor?
Yeah, we are an impact investor.
Okay.
Yeah.
I guess looking at this slide, the only bit that I might nuance a little more is saying you screen for ESG risks in the ESG sector. And I think echoing what Jasper said, I think ESG can be something that every company thinks about, and it's not necessarily something you screen for or screen out. I think, you know, any company that's got property on the coast needs to think about what's going to happen when oceans rise. And, you know, every company that operates in other areas have other risks that they need to think about, consider, and plan for. And that's where the term sustainability comes in, that if you are thinking about and managing these risks, you're more likely to be sustainable and make it through years like 2020, when, you know, big things can happen to you and you have to figure out a way to manage through it and exist it after it's over.
And I think the only thing I would add is just to unpack the ESG investing one a little bit more. There's a couple different techniques under that. So one would be exclusion, which means you can decide as a fund, we don't invest in certain things. So that could be exclusion of fossil fuels or weapons or tobacco, whatever. And then there's sort of active management ESG, due diligence active management. So we're screening in based on a certain profile, or we're sort of looking at it in the process and factoring it into our valuations. Active management could be for more in more the public company sector, things like proxy voting or having conversations with management. And then, yeah, so there's sort of like those three separate buckets of like what falls under ESG investing. And like Hillary said, it's everybody has ESG. Impact is sort of, as an investment category, it's sort of a subcategory, but my personal opinion is that all companies have impact, so everyone should be measuring their impacts, whatever those are, even if they don't map to traditional impact frameworks.
Fantastic. I completely agree with all of you, by the way. one thing I did want to, and I thought would be helpful for the audience, is to kind of talk a little bit about how 500 approaches that. So that might help to clarify a little bit. So we are not currently an impact investor. We don't have any sort of funds that are looking at screening investments by looking at sort of what is the outcome or the impact that they can achieve in addition to sort of ESG. What we decided to do in our most recent fund is to apply, and to your point, Susan, take both an active role in terms of sort of excluding companies. So we designed a process by which when companies apply for funding from 500, we have two parts to our ESG criteria. The first part is excluding those companies that, making sure that child labor and other, tobacco and other things are not part of their business plan or business model. And then we have a second part to our process, which is around identifying opportunities for value. And I took a lot from both the work that FMO did and also the research that you provided, Susan, when I was designing what are the areas that we could look for, especially with startups. And we can get into sort of some of the challenges around startups and a little bit later on. But what we decided we could do at a minimum is start to look at things like compliance around data privacy. We could start to sort of ask companies or startups around having policies in place for, non-discrimination, for diversity practices, making sure that, they have, sort of gender equality baked into their sort of planning around how they think that they're going to build the company. And we thought, what better time than to begin? Like it's never too early to start thinking about these things. As all of you mentioned, we think it's both a tool for mitigating risk, but also one that will enable them to be more resilient and to capture value ongoing. So our approach, because of the stage of investment that which is quite early, we decided that we would sort of take this approach to at least starting to look at policies and practices of the company. So we wouldn't characterize ourselves as an impact investor. At least currently, we don't have any funds that focus specifically on achieving an impact goal, but we definitely, in our most recent fund, screen companies based on ESG. And then once we screen them, we provide them with training, like today's talk and many more to come, and tools and resources to help them sort of adapt and adopt policies and practices that will help them to be ESG compliant. And then we measure them ongoing. So just as a point of reference. So one of the things that I've noticed, and this certainly is not sort of necessarily new to me, so I have a little bit of skepticism about it, but there is it seems to be a growing interest in ESG. Lots and lots of headlines. I don't know if it's post-pandemic that's brought a spotlight to it, but it seems to be more and more part of the discussion, and there seems to be more interest in it. In particular, I think there's a lot of interest growing in with respect to venture capital and the role of venture capital. And so since all of you have produced reports or research along these topics, I wanted to kind of survey you on what your thinking is or thoughts are, experience has been with respect to producing reports and research along these lines, and what prompted you to do that. I know, so I'll start with you, Hillary. I know that the last time that PitchBook did a survey of sustainable investors was 2016. And so I'm kind of curious to understand sort of what was the thinking about doing a survey in 2020? Was there any kind of momentum, and were you hearing more from your own clients about interest in this topic? So I'll start with you.
Yeah, and I joined PitchBook in January, and I'm not quite sure why they stopped doing the survey. They did it, I think, in 2012, 13, 14, 15, and 16. It might have just been there was some internal reorg. The publishing and editorial teams had grown quite a lot, and people had their own specialties. But Part of it is that our parent company, Morningstar, actually had a very big initiative that all aspects of their business were going to have an impact and have a market presence in this space. And so reviving the survey really seemed like a good place to start. It also allowed us to do some market research. We had some open-ended questions that we could ask participants about what their data needs are, what their frustrations are, and see how we can maybe provide product that is better suited to the environment. So I think that's really what got the project going, and then just having a person that's partially dedicated to the space, being me, got it actually off the ground and running again.
And when you, were there any sort of ahas or surprises or insights that you didn't expect from the research?
I thought it was one of the funny ones, and there were questions that were totally unrelated to each other, but the responses were curious. That one of the biggest driving forces that both asset managers and asset owners said was driving them towards doing something in the sustainable investing space was that they believe that it will lead to improved investment returns. That, you know, pricing in risks and, you know, making sure that those are covered and that they're less risky possibly if you're focusing on them, could lead to improved investment returns. But on the flip side, when we asked them about their biggest challenges to implementing such a program, it is the perception that investment returns will be lower. And so, you know, the people who responded to the survey absolutely believe in the space and believe it's going to improve their output, but convincing other people of that is still a pretty big challenge.
Yeah. And so Jasper, you, our FMO along with ERM published a paper earlier this year, which I really used as a guide. So thank you for that. It was a fantastic piece. But I'm curious as to what sort of prompted the initiative to put together sort of a framework and to look at venture capital as a potential sort of asset class to adopt ESG.
Yeah, for us, the starting point was really that we as FMO decided to go a bit downstream in terms of that we wanted to invest in venture capital, so relatively early stage companies. We saw that with the rise of fintech, rise of other technology companies, either in the agri space or in the energy space, it provided a very good entry point for us to create impact and to reach communities that we could not reach via more traditional private equity or debt investments in more established companies. So basically the starting point was that we wanted to move into investing in early stage companies. And then basically what we wanted to do is to amend our current approach on environmental, social, and governance to the very specifics of venture capital. And that's the reason why we teamed up with ERM and CDC to work on a piece that sets basically the guidance for ENS. We did something similar with Action on the topic of corporate governance. Both with the idea basically to set certain standards of what we actually would look at from an ENS and corporate governance perspective in those early stage companies, both from a risk management perspective, as well as, again, trying to see how we can work with these early stage companies to create additional value. So that was the starting point to come up with guidance notes, and subsequently we had to adapt our approach and our policies to the very specific of venture capital investing. And basically for us it was a new asset class. So I think we have a lot of experience in doing ESG for the more established private equity and the debt transactions, but not so much for the venture capital space. And that's why we reached out to entrepreneurs, investors, universities, etc., basically to get their testimonials on things that worked and didn't work out in the venture capital space, and already the idea to set a certain framework that can serve as a reference for ESG investing in venture capital.
Great. And Susan, I also really loved your piece on responsible investing in venture capital, and I'm also curious about sort of what around the timing and sort of what prompted, what was the impetus for putting together the research?
Yeah, so the fellowship program I was doing at Harvard, as I mentioned, like their thesis or what they wanted to work on was how to think about making sure this next generation of technologies just coming out of the university laboratories today that are being commercialized can ensure that they have what we call public purpose, or ESG, is integrated into their business models and product design from the very beginning. So from that first day that it takes its step, it's a commercial agreement written between a lab and, it makes its journey out into the world. So that was really sort of our impetus. And then, coming from an ESG and CSR background, I became very curious about why venture capital was the only asset class that didn't have a toolkit or research. Or, if you go on UNPRI, the Principles for Responsible Investments website, you can get things for commodities and real estate. And so that for me was really the impetus of this research. And I think we spent our first year really just trying to dig into the why question. So why aren't they doing this? And then what are the barriers that they're facing for actually being able to implement this? So we did one paper the first year, just really exploring that question. And then the second year, we really tried to focus on like what the solutions were. And that's the paper that you reference here is sort of what we think 3 or 4 pathways might be to advance ESG across venture capital.
Great. That's actually a great sort of segue into the next section, which is to talk about some of these kind of challenges. I took from the PitchBook survey, I took one of the sort of pieces, Hillary, around some of the survey responses to what are some of the challenges, but picking up on that thread, Susan, I'd love to know sort of what did you uncover as reasons why venture hasn't adopted any of these kinds of policies or practices to date?
Yeah, so I think what we learned, and our sample is obviously much smaller than the PitchBook study. We probably talked between 30 and 50 over the 2 years. One of the things we learned that was kind of surprising was that how many general partners, particularly large venture capital funds, had never heard the term ESG before. So even getting them started, or we started a conference called, I think it was Responsible Investing in Venture Capital. We had to change the name of it because they found the word responsible offensive, because they're like, oh, you think we're irresponsible investors. So it was just a lot of like, in the beginning, like, no, it's not a comment that we think you're irresponsible, but this is what ESG is. Here's what ESG integration means. So it was like a lot of sort of education in the beginning. And then like some of the other things we found, other than just total like lack of awareness in the venture capital community, was they said, okay, that's interesting, but where are the definitions? Where are the tools that can kind of support us? Startups have small teams. We don't have ESG people. It's usually a few like technical and marketing people. So they really felt like there was a big barrier on like the technical issues. And then there's some interesting dynamics in the industry around like the GP-LP relationship that we kept hearing about, that either our LPs aren't asking us about this, or they don't value this, or vice versa. Like if the LPs are like, well, the GPs that the funds we want to be in don't have processes and aren't interested in engaging. So we were truly trying to unpack what all these different barriers were, and then try to map what we thought some solutions could be to overcome those barriers.
Yeah, it's all of those barriers I have experienced and have familiarity with. Susan or Hillary, when you sort of looked at the results of some of the survey, was there anything that stood out to you in terms of sort of challenges that were unexpected, or is this sort of in line with some of what you've also sort of experienced or learned?
Yeah, I don't think it's horribly surprising that the top challenge is about measuring and defining impact. I think what Susan was just saying supports that too, that there are just so many ways to look at it. I've talked to a couple asset managers, I think one was PE and one was VC, who said, oh, we do not use the word impact. Yes, we're trying to have positive impact and we're trying to measure those, but we don't use that word because we think that limited partners or potential limited partners are going to assume that returns will be lower. And they say nothing could be further from the truth. We're trying to make profits. We're just trying to do it in a way that makes the world better. So, terminology and measurement are still absolutely a problem. One of our open-ended questions was, it was a closed-ended question with the opportunity to provide some support, and it was, how are you measuring impact? And the choice was basically through some standardized framework or through something customized. And the vast majority said they're doing something customized just because the standardized frameworks don't support what they're trying to do necessarily. But if everybody is customized, then just think about the problem of an investor who's invested with a wide variety of asset managers, and they're getting different reports from everybody, and then trying to put that together into a report for their investment committee is a headache. So, you know, I really think that this measurement and definitions continues to be a problem. So yeah.
Yeah. Jasper is somebody who's actually on the practicing side of implementing sort of impact strategies where your investments are measured, and you do apply a framework to that. Two-part question. One is the sort of perception that there are lower returns. I'd love you to comment on that. And then two, you know, how difficult is it to implement sort of metrics, do you think?
I think the first item, so that it's perceived as being related to lower returns, is not necessarily something that I see on a daily basis, and it has to do with the fact that we have it as kind of a key point of our investment process. So we don't necessarily come in close contact with a lot of investable assets that don't necessarily think it's a good idea to focus on the topic of ESG. I think where I see the most pushback in my daily work is that it's indeed related to the definition. So what and how can we implement it, and how can we make it very specific to the kind of institution or company that we are. That is something that I see as a struggle. And I think something that is also very prominent in early stage companies is that it's a constant fight for priorities, right? So there are a lot of things that come on the plate of the entrepreneurs or the small leadership team, and then the topic of ESG or impact measurement might not be of the highest priority. And especially the corporate governance in the ESG was sometimes perceived as being a bit of a burden to a relatively early stage company. So it's indeed the fight for priorities and getting it on the agenda, and getting it on the agenda timely enough, I think is the main challenge that I have on a daily basis working with the investees.
Tracy, I was going to add another sort of conflict in the industry is that, and I experienced this when I worked for a foundation at my most recent prior employer, is a lot of investors have very specific things in the world they want to impact. You know, at my foundation, we wanted to look outside our window and say, I impacted that, you know? And so finding a product that is able to meet that mission is super difficult, because the asset managers want to find something that's scalable that a lot of people will want to invest in. So, you know, that's why you find a lot of product related to carbon emissions or something like that, because it's something that more potential clients might be willing to sign on for. But if you're trying to improve the housing situation in places like San Francisco or St. Paul, Minnesota, it's hard to find investors that are going to fill up a fund and be scalable enough to provide a product for that. So it's kind of buried in this particular data in terms of a challenge. But you know, I know that GPs are frustrated in finding LPs that'll sign up for their products, and a lot of LPs are frustrated because they can't find the product that matches the mission they have.
Yeah, I can certainly echo those experiences. I think, you know, when often asked, can you sort of achieve impact and, you know, have good returns, you know, I always respond, like, depends on how you define impact. So, you know, I think that's a sliding scale. Like, you know, certainly if you started with creating jobs as an impact, you know, you probably could find a lot of companies that are creating jobs. But the sort of farther that you move towards filtering companies based on very specific impact objectives, it does actually narrow the pool of potential investments. And so I think that's where some of the perception around returns comes, because you're looking for, at least in my experience, working especially in emerging and developing markets when I was at Bamboo Capital Partners, hard to fill a fund, hard to build a, you know, $200 million fund that invests in developing countries, having people on the ground, really understanding the dynamics of that, with a traditional sort of investment structure of 2%. You know, management fees. It's a challenge to do. On top of that, adding a layer of, you know, measuring sort of the impact of those investments on top of that. And you know, because ecosystems are, you know, evolving and developing at different rates, difficult to find companies that can grow and scale at the rate you need them to in order to produce those kinds of returns. So it's always this sort of, challenge of figuring out like what is sort of I think the sort of largest filter that you can think of in terms of, actually making sure that companies have an impact, a positive impact, but at the same time that there's enough of a pool of investments that you can make and measure in order to sort of fit in with traditional sort of structures of funds, given the types of fee structures that are there and the sort of breadth of geographies and also potentially sectors that you might have to sort of go across in order to achieve that. So it's not, at least in my experience, impact is a hard thing to do because, and it's stated, I think in some ways, a very niche sort of asset class still for those reasons. I think it's kind of challenging to sort of build lots and lots of capital. That may be changing, and I hope it is. But for us at 500, I really looked at the starting point of ESG because of a lot of the things that you've all mentioned, which is, that the venture didn't have a lot of practices. They would, in terms of just some minimum guidelines around how companies can start to think about certain aspects of their business and making sure they're mitigating risk and managing risk using an ESG framework. And so, and also I think, the paper that FMO was part of publishing was really good in that it addressed this issue or this challenge of early stage, because another one of the challenges is it too early? If you're a team of 2 to 10 people, when do you start to think about sort of HR policies? When do you start to think about implementing non-discrimination policies? When does it make sense for you to start to think about board makeup if you're at the very, very early stages? And I thought that the paper that FMO and ERM and CDC put out was a great guide. It was a great guide to say, okay, you can start to do these things. And particularly if you look at things like data privacy in the tech startup space, that's becoming more and more sort of a risk that needs to be managed. And the sooner you start to think about that, the better. So that's how we ended up at, sort of starting with the sort of minimum of looking at ESG as a filter for our companies. And then the hope is that we'll learn and continue to iterate on that as we go along and hopefully share that with the rest of the field. So moving from challenges to opportunities, I thought I also included your sort of pitch book chart on some of the drivers, and I thought it would be worth kind of talking about because there, obviously has been a lot of discussion recently about venture capital in particular. I would say the lack of diversity in venture capital, certainly the pandemic. There are a lot of, I think, things, elections that are driving more and more of the discussion around responsibility and shared responsibility. And now it seems to be a great time for us to start thinking about this as investors, as a community. And so I wanted to get your thoughts on some of the drivers and the opportunities. So I'll start with you, Susan.
Yeah, I think this is similar to sort of what we heard from sort of our conversations and sort of what we presented in our report. From the LP side, I think the principal thing they were concerned about was either risk mitigation or sort of reputational risk. So are we invested in something that we could end up on the front page of the New York Times being shamed for something some startup is doing? So that was sort of, I think, where they were coming from. And also, they just wanted a pathway to be able to measure their impact, right? So if they wanted to communicate to their asset owners, here is the impact that we do have, even if it's not an impact fund, having access to like that kind of data so that they were able to do that. And then if they made public ESG commitments, particularly around things like diversity and inclusion, being able to monitor and communicate that. So I think that's kind of consistent, what PitchBook found in their larger survey as being sort of the drivers of this. And then on the GP side, I think for us, what we heard of the ones that kind of got it and understood it, they said it's, ESG is, it's just an additional layer of analysis to the things that we're already looking at. So things like product market fit and team and other things like that, having some additional outside analysis telling us, is this a good technological solution? Is this a technology that's ready for market? Are we at high risk of having a regulatory infraction in this particular product category? So having some information to help validate that or help them sort of prioritize among selecting and managing investments. So overall, yeah, very similar to what we heard talking to people.
Hillary, anything that jumped out as surprising to you when you saw the results?
Well, I mean, I guess the first thing I should highlight, and I guess we didn't say it up front, is we had 368 respondents, so it actually felt like a really robust data set. I honestly, going into this, I'd never run a survey, and I thought, oh, if we're sending this out to 800,000 people, I assume we'll get over 1,000, but apparently our response rate was 3 times bigger than anything we've ever done at PitchBook for a survey, so we were very pleased with the results. I was going to say that one thing that we did find interesting, we asked a question about how people are feeling about their sustainable efforts in 2020. I think it's fairly well known that in the US, a lot of people saw this as a nice to have back during the financial crisis and kind of backed off from it because they had other fires they had to take care of. And from that, I guess I'm speaking of institutional investors. I was working at a state pension at the time. But this year, and granted our survey it's got to be fairly skewed towards people that are interested in the topic, the people that actually finished the survey. So, take it as you will. But a lot of people said, no, we're actually increasing our focus. And when we provided an open-ended response, they said, the issues of COVID and the issues of Black Lives Matter protests, because this was running in July and August, are really causing people to focus more on stakeholders and more on sustainability and more on these issues that will make companies better and more able to withstand shocks like we've seen in 2020. So we're seeing people that are doubling down on this area instead of backing off like they did in the last crisis.
Fantastic. And Jasper, since you do a lot of work in the frontier markets and emerging markets, I'd love to hear your perspective on, what are some of the drivers and opportunities that you're seeing there?
Yeah, I think it's a bit of a given that indeed in the markets that we operate in, that the companies all operate in very volatile environments, potentially also complex environments from a risk perspective. And that's indeed an area where there's a lot of focus on the value addition. So how can companies be more resilient? How can they make decisions to remain successful in the long term? How can they adequately communicate with their local stakeholders? How can they move to kind of a maturity state where they're more attractive for commercial funders? So they're all kind of drivers for them to focus on impact, but also on ESG and topics in connection to each other. So I think especially the volatility in our markets basically is one of the main drivers for focusing on that.
Can you mention some of the markets that you're invested in? Some of the countries?
We invest in Latin America, with the exception of Brazil and Chile, most of Africa and most of Southeast Asia. So the middle income and low income countries, with a few exceptions. Yeah.
Okay, fantastic. Well, lots of opportunities. What I thought would also be helpful is, since you have been really helpful in terms of putting out some frameworks, both Susan and Jasper, I'd love to hear from you sort of, if people are motivated now to sort of adopt ESG and or impact kind of measurements and approaches, sort of what would be some of the ways in which they could get started. So I'll start with you, Susan.
Yeah, so I think in the report we sort of outlined 3 areas or 3 buckets of things that could be done. The first one I think is where there's already a lot of momentum inside the venture capital community, which is diversity and inclusion. So this would be sort of actively trying to bring more diverse people into both the founding teams of startups and the funds themselves. And we highlighted several initiatives that are already sort of working on that. The second area that we looked at for opportunity was around technology and risk assessment. So building tools that startups can actually use to evaluate, what what issues are most material for them, and then thinking about when in the overall work plan of everything we need to get done over the next 1 to 5 years, would we need to start thinking about this and taking specific action. So in the back of the report, I did a little demo just with based off a couple of real companies. It's a hypothetical company, but we sort of walked them through that process just to show how do you do that materiality assessment? How do you come up with sort of your top impact metrics? And then the other one we looked at was the need for data and transparency around the early stage to growth stage companies, and then what would that look like? So, just sort of integrating what we heard talking to GPs and LPs, if hypothetically one were to build a data set and put it into an interface like PitchBook, what might that look like? What kinds of data might we want to collect on startups? So those were sort of the 3 buckets of solutions we proposed in our report.
Hillary, sounds like a product opportunity there.
We're certainly thinking about it.
And Jasper, again, like I really appreciated the sort of piece and the framework. It really helped me in terms of designing our own ESG approach. But I'd love if you could give some highlights about ways in which companies, even at the earliest stages, and investors could get started with integrating ESG and impact investing into their own diligence and processes.
Yeah, I think for me, the main lesson learned from investing in early stage companies, but also from the research pieces we have done, is that it's important for early stage companies to start considering ESG very early in the development of their companies, and start with a very basic approach that can be around identifying the ESG risks that are associated with the business. It can be about establishing basic financial oversight of the company. And then I think most important is that the ESG practices basically develop over time alongside the further development of the company in terms of size, complexity, risks, etc. So I think from that perspective, I think the early stage companies, we should acknowledge that they are relatively low standards in terms of the structures and practices that they might have from an ESG perspective. But I think also with that in mind, it's important that they start early with basic processes like risk identification, oversight, etc. And then critically think about, okay, how can it develop over time alongside the maturity of the company? And again, going back to my earlier point, I think it's also a constant battle for priorities there. So it might not be highest on the agenda, especially for entrepreneurs, but I've seen over and over again that it really benefits the companies if they start considering it early in their development.
And potentially opening them up to other sort of pools of capital as well.
Absolutely. So over time, they need to move to a situation where they basically meet investor expectations that might be a bit different from what we as a development finance institution find acceptable. So also there we have kind of the value to add to make sure that they move to, let's say, more mature states in terms of ESG practices. And that is not something that can be done overnight. It's not like, okay, I want to attract capital in a couple of months from now, and now I have to make sure that I do right on ESG and impact, etc. It's a long-term process with incremental steps to get to a better place.
Great. So we have a couple of questions. One is, the first question is, where do you feel a B Lab type assessment as applied to B Corps fits into the ESG landscape? Anybody on the panel want to take that one? I have some thoughts, but let you go first. Did you come across B Corp, Susan, in any of your research?
No, I think we were focused more on sort of like high growth venture capital funds. So I guess the B Corp wasn't as common. I think it's definitely a pathway that I think more startups should look at. And they have, in the toolkit we built, we use SASB because SASB has like very granular things at the industry level where we really needed to dig deep into AI algorithms or how to manage, a workflow inside of a hospital, things like that, where SASB has really good guidance on that. So we use that one, but I think the B Corps, it's another pathway that I think should be explored more.
Yeah. For me, so just as we were putting together the ESG policy for 500, I essentially sort of took, SASB and GRI and IOC exclusion list and the B Corp, all of their various, and IRIS, all of the various metrics, and sort of tried to narrow those down to what would be applicable, to your point, Jasper, at what stage of, sort of the company. And I think for the earliest stage, so pre-seed, our questionnaire ends up being about 24 questions. But as the company grows, we of course are adjusting those metrics. If we do follow-on investments, for example, we do adjust those metrics based on the growth plan of the company. I think in my experience, B Corp goes above and beyond even ESG. There's a questionnaire is 124 questions or something like that. The other benefit that you have from something like participating in a B Corp sort of assessment is you get to benchmark yourself against your peers, which is nice because there's, as mentioned earlier, there's not a lot of data sets out there right now to do that kind of benchmarking. So that's another benefit. But I would say in terms of how it fits with ESG, I would say it's ESG plus. They're looking at sort of 5 different dimensions, including communities and stakeholders. And baked within that sort of assessment are a lot of the sort of, for at least the startup stage, a lot of the ESG questions that we would be looking for and asking about. So I think that's how, at least my perception of how BLAP fits into the ESG landscape. The second question is, based on the research that Susan did, at which stages do companies start to consider ESG for startups?
If you look sort of in the back of the report, what we did is we sort of walked a hypothetical company through that. And basically what we propose that they do is that, once you've completed your materiality assessment of what do you need to sort of be managing, put that into sort of a work plan with everything else that your company needs to be doing that year. So if you have questions about, are we regulated by the FDA? What does that workflow look like? And at what points, in your product development, testing, launch, do you need to start having those dialogues with the FDA or with other regulators? Or, at what point, do we need to start thinking about our data privacy policy? So really, I think our approach to it was that you could start that process at any stage. We recommended, even at seed stage, just take a day and just on a whiteboard, just try to do it really quickly in one day. You're not going to have all the answers that first day, obviously, but that'll at least kind of give you a roadmap of, is this a good product? Should we even be pursuing this? Is there a product market fit? It can help you answer all those other questions, right? And then as you grow and scale, you just come back and just keep revisiting these questions, and put firm deadlines and firm actions around implementing each one of them when it makes sense, like in the growth of your company.
Great. And if you are part of the 500 family, we will help you also to get there. So shameless plug for 500, but that is part of the work that we're doing to help educate and provide tools for companies to get started with ESG. So final question for Jasper, is there any industry you're finding particularly disruptive in Latin America, particularly Colombia?
Yeah, I think from an FMO perspective, what I would consider disruptive from an FMO perspective is if we can find companies that are able to reach out to underserved markets in a more effective and efficient way. So how can we, for example, reach out to individuals that don't have any access to banking? How can we provide access to energy for those that are not on the grid? How can we help smaller farmers? So everything that can help those groups and that can actually bring our impact in those local communities, that is something that for us is disruptive. Whereas from more kind of a technical perspective, it might not be as disruptive as others classify it. So from our perspective, from an impact perspective, for example, all of the fintech industry is obviously something for us that is disruptive because it basically allows us to reach out to non-banked communities that have mobile phones but that don't have access to banking services. The same applies to, for example, agri-tech companies that work with kind of drone systems to make sure that the the quality of crops that comes from different smallholder farmers in a certain region is from a consistent quality, and that helps them with their selling that in the international market. So with these kind of technologies, we are able to help and to reach out to communities that we can't reach via more traditional investments, let's say in financial institutions and local banks, etc. So disruptive from an FMO perspective is really disruptive in terms of how can we use innovative business models, technology-based business models to reach out to those communities.
Great. So we're getting close on time. So I thought it would be fun just to do, it's that time of year for predictions, although I don't know if that applies this year. But I thought it would be fun just to kind of, given where we are today, I looked at one of the questions that really stood out to me from the PitchBook report was this questions around GPs that require portfolio companies to, focus on financially material sort of, risk factors and the number I'm wondering, so 75% versus 25%. So one, I wanted to ask the audience, so Natalie, if you could share the poll on where do you think these numbers will be in 2021?
Guess I better make sure to ask that question again next year.
Oh, a lot of increases, yay.
Actually, what was interesting about this result is that this is a little more rubber meets the road. There were other questions that said how are you on your progress of implementing your policies? And there were a lot more that said, oh yeah, we're doing it, or we're on a path to doing more, versus this is how many are actually requiring it of their portfolio companies. So I don't know if that's a indication of greenwashing or just, still on a path.
Yes, so I'm very curious to see how it evolves. So wow, okay, so 36% see it as increasing and only 4%, nobody thought it was going to decrease. That's hopeful. So how about, I'll ask the panelists, sort of, what do you think?
I don't think they're wrong. I mean, everything I'm seeing is showing that we've moved past the what is this ESG thing towards how do we implement it? And if they're already working on implementation, I don't see them backing off of it if they've already started to put resources towards it.
Susan or Jasper, any other comments or thoughts about where we'll be this time next year?
Yeah, I agree. I think what's promising, even just in the last couple of weeks, it seems like there's a new report or framework coming out every couple of days on this topic right now. It's hard to keep up with them all. So I'm hopeful that, once this gets out there, and particularly some of the bigger LPs in this space adopt some of this, I think we will see more GPs requiring it in the next year.
Absolutely.
So as well, I think my hope for the future is that also more and more investors and GPs will also dedicate the resources to it. And so I think it's one, to ask it from your investees, but to have the resources to focus on it, to do the assessment, to focus on value add. I think that's the next step. And it comes with a certain cost, right? So let's see what also the scrutiny is provided in budgets from the COVID crisis will do for that.
Yeah, definitely. All right. Well, thank you so much for participating in this. I really appreciate all of the work that you've done, and also for taking the time to share your thoughts with us today. A couple of things that I wanted to just mention to the audience before we go, which is that we, as I mentioned, this is part of an ongoing series for us at 500 to talk about this topic of ESG and continue to share with our founder community, our investor community. We will continue to sort of publish our experience as we are sort of going through it and applying it to our portfolio through our latest global flagship fund, Fund 5. And so coming on October 28th, we will have Lyle Resner speak with us. He's the co-founder of Swayable and also a professor of public interest in technology and social innovation at NYU. I thought this would be a very timely topic to talk about prior to the election. And then on November 2nd, we will have Alex Rosenblatt, who wrote the book Uberland, who also speaks a lot about sort of the treatment of gig workers and sort of how tech startups can shape labor. So those are two of the upcoming topics, and we'll continue to have speakers ongoing. And the best place to kind of stay in touch is to keep an eye out at our sort of 500 startups ESG page. And also, I think via signing up for this, you'll receive our newsletter. So that will also keep you in the loop as to what's happening for us. So again, unless there's any other questions, I think we'll close out. And thank you, all of you, Jasper, Hillary, and Susan.